Palantir stock is up 25% after earnings, and today we're going to talk about what option prices look like post-earnings event and whether or not it makes sense to be trading options right now. Now, if you like the analysis we do in today's video and want to learn a few of the option trading strategies that we run at Predicting Alpha, you can click the link in the description and get a 7-day free trial with us, where you get full access to our strategy masterclasses, our options data terminal, which comes with the scanners and analytics you need to actually price volatility, and of course, the Predicting Alpha community, where myself and all the other members work together to trade with an edge. So let's take a look at Palantir and see what things look like. All right, so Palantir moved 26.38% today. Absolutely insane for a $200 billion company to do. The implied move for earnings was 12%, so, about a 14% beat on earnings there. Pretty crazy. And looking at the backtest for earnings, we can see that Palantir tends to move a lot around earnings. Taking a look at the last couple of years of events, it's almost every time beaten the implied move. It's actually for this reason that a few people I know from the Predicting Alpha community were long volatility going into Palantir earnings. It just seems like the market doesn't know how to price vol around this ticker, especially around earnings, and the stock seems to consistently be moving more than implied on the earnings event itself. Now, the question we need to ask as option traders is, what should happen to volatility post-earnings? Should implied volatility overstate realized volatility? Meaning, should there be a variance risk premium baked into option prices right now? Or do we think that realized volatility will actually outpace implied even though the earnings event is over, which would mean that buying options would be the right play? Well, the thing is this, actually forecasting what tomorrow's volatility is going to be is hard to do better than the market. Implied volatility tends to be a pretty good measure. So rather than trying to do some magical forecast of what's going to happen next, what I like to do is simply look at long-term trends. Does implied volatility tend to overstate the subsequent realized volatility, or do we see that on average, over long periods of time, the realized volatility is actually higher than implied? Well, to answer this question, we have a chart in the Predicting Alpha terminal that basically does this math for us. So right here in the Predicting Alpha platform is a chart that actually does this math for us. It's simply called the variance risk premium. And what we do, if we zoom in here, is each of these bars is the implied volatility 30-day that was measured on, let's say, for this one, July 20th, 2022. So what we do for this data point is we say the implied volatility was 64.8%. And then the future realized volatility, meaning if we measured the next 30 days, the stock actually moved 58.66%, meaning that the difference between implied and subsequent realized, or the variance risk premium, was 6 points of volatility. And what we do then is we do this calculation for an entire 4-year period, which is what you see here. Each of these bars is 1 day's measurement, and then we wait 30 days, we pull that data back, and we see what the VRP was for that day. Taking a look at Palantir here, we can see that there's a lot of red. There are extended periods where the realized volatility is outpacing implied. And we can actually see that the average variance risk premium, not including earnings events, which is what this non-event means, is negative. And not just a little bit negative, but 3.5 points negative. Looking at the insights here, the most recent 30-day window we measured had a negative VRP of almost 3 points as well. And it's only existed, meaning the VRP has only been positive about 46% of the time. Now, one of the things we know about how variance risk premium works is that it's supposed to be there on average, meaning a higher percentage of the time, we should be seeing a positive variance risk premium, and then we should be seeing periods where there are drawdowns that happen less frequently, but with a higher degree of volatility. In this case, what we're seeing is that most of the time, the VRP is actually negative, which combined with the increased volatility in Palantir makes me think that buying options here actually could be a good play. And that's actually the view that I take on this right now. I actually think buying options on Palantir is not such a bad idea. And I'll get more into how I'd structure this trade and how I think about it in terms of my portfolio towards the end of this video. But I have one more data point to support this thesis that I want to share with you now. So coming down here, taking a look at this, let's look at some short-dated options. This is the 10-day realized volatility, and the blue line is the 10-day non-event implied volatility. Now, what do you notice? Obviously, they move together, but there are extended periods of time. Here, very recently here. There are extended periods of time where the realized volatility is outpacing the implied. And if we switch over to 30-day options, we see a very similar story, where there's these huge periods of time where realized volatility is just significantly higher than implied. And remember, we're looking at non-event data here. So we've taken out the impact of earnings when we're looking at this, which is really what's happening now that the earnings event is over. That's why this is a reasonable thing for us to look at. Combining what we're seeing here in terms of recent realized volatility data compared to implied, with the fact that there's on average a negative variance risk premium here, leads me to think that buying options here and gamma scalping them, meaning we're still not taking a directional view, is likely a reasonable trade to take. And given that most of the time we're selling options, when we can find opportunities where buying options is something that might make sense, it's worth us doing it because we need to get some long vol exposure into our book to help us offset those times where realized volatility in the general market just picks up. If we can find areas where implied volatility is cheap, or at least break even, it literally has no correlation to the other strategies that we run, which makes it something that we really want to find for our portfolios. Now, coming back to the platform here, if we just take a quick look at the volatility cone, we can see that we are in the upper quartile for the short-term volatility, which is what we're likely to be trading here. We're around the 75th to 80th percentile for where implied volatility can be for, let's say, 20-day options, but we're nowhere near the max, right? Volatility has been as high as 98 in the last year for that 20-day option, and we're sitting at around 65 right now. So I don't necessarily think that this is going to realize, let's say, 100 vol, but I could totally see it realizing 70 or 80 vol and maybe having a few big spikes that is really what we want exposure to. We're hoping that on average, buying, let's say, this 20-day option allows us to break even most of the time while giving us exposure to that tail risk of, let's say, the stock going up another 15 or 20%. And so with that in mind, the way that I would structure this trade is I would be buying an at-the-money straddle, let's say 20 days out, and then I would be doing a daily delta hedge. The reason I'm doing this is because I don't actually know what direction Palantir is going to go. And so I don't want that to be what drives my P&L. The thing that I want to drive my P&L is the difference between implied and realized volatility. So by gamma scalping the position, I'm able to keep my P&L pretty tight to that difference between implied and realized volatility. And then if, let's say, we do happen to get a one-day massive spike, another 10 or 15% move, then we're going to get exposure to that as well, and I'd likely close out the trade then. So there you have it. That's the analysis on Palantir. This is what I basically do for most of the tickers that I'm trading, long or short vol. If I'm selling options, I'm looking for that positive VRP. If I'm buying options, a big part of the analysis is that negative VRP. And by doing this, I can put together a decent portfolio without needing to really predict what the future holds too much. Keeps my variance relatively tight, allows me to have a couple different strategies running at the same time, and overall, it works pretty well. So that's it for this video. Make sure to like and subscribe. And of course, if you have any questions about the analysis, the comment box below, leave your questions there, and I get back to everyone. All right, everyone, take care, and we'll see you next time.